Your car insurance went up this year. You didn't get in an accident, you didn't get a ticket, you didn't move, you didn't buy a new car, nothing changed. And yet the bill is higher. Here's what they won't tell you. Your insurance company has a name for people like you. They call you a passive customer. And there's an algorithm running right now specifically designed to extract more money from you every single renewal. Not because you're a higher risk. Because their data says you probably won't leave. This is not a conspiracy theory. State insurance commissioners have investigated it. Actuaries have testified about it. And the practice has been banned in several states, which means it was real enough to ban. Let's talk about what this is actually costing you. The average American pays $2,150 a year for car insurance in 2024. That's up 26% from just 2 years ago. 26%. Your salary didn't go up 26%. Your car didn't get more expensive to repair overnight. But here's the number that should make you angry. Customers who switch insurance providers save an average of $700 per year. $700. That's not a rounding error. That's a car payment. That's a vacation. That's money that left your account quietly every month because you stayed loyal to a company that was betting you wouldn't check. And the longer you stay, the worse it gets. Studies show that customers who have been with the same insurer for 5 or more years pay on average 18% more than a brand new customer. For the exact same coverage, same car, same driver, same address. You get punished for staying. They even have a term for it. Insurance economists call it the loyalty penalty. The industry calls it pricing segmentation. You call it your monthly bill. This isn't opinion. In 2015, the Consumer Federation of America published a report documenting how major insurers use factors that have nothing to do with how likely you are to crash to set prices. The practice is called price optimization. The state of California banned it. Maryland banned it. Florida issued warnings against it. The data we're using comes from actuarial reports, state insurance commission filings, and independent studies from ProPublica and the Consumer Federation. These numbers are documented and verified. Now let's talk about exactly how it works and what you can do about it. Your insurer uses behavioral data to predict whether you'll shop around and prices your renewal accordingly. Insurance companies don't just look at your driving record when they set your price. They buy data from third-party data brokers. That data includes how often you visit comparison websites, whether you've requested quotes from competitors, and how long you've been a customer. If the model predicts you're unlikely to leave because you haven't shopped in years, because you're bundled with home insurance, because you always auto-renew, it flags you for a raise you probably won't react to. A 2022 internal document from a major U.S. insurer, cited in a ProPublica investigation, described this process explicitly. Customers are segmented by their predicted price sensitivity before renewals are generated. Translation: they know who will complain and who will pay, and they charge accordingly. Here's what you do right now. Set a calendar reminder 2 weeks before your renewal date. Get at least 3 competing quotes. Do not call your current insurer first. Get the competitor prices in writing. Then call your insurer and tell them you have a lower quote. The retention department has tools the regular customer service line does not. Rate reductions happen on that call, or not at all. The average customer who does this saves $340 on the spot without switching a single thing. Here's a number that should stop you cold. The insurance industry spent $9.2 billion on advertising last year. That money comes from somewhere. It comes from the gap between what they charge loyal customers and what they charge new ones. Insurers use a separate hidden score called a credit-based insurance score, and it can change your premium by hundreds of dollars with zero connection to your driving. Most people know that insurance companies check credit. What most people don't know is that they're not using your credit score. They're using a proprietary version of it, recalculated specifically for insurance pricing, that you have no legal right to see in most states. Here's a real example. 2 drivers, same car, same zip code, same clean driving record. Driver A has a credit-based insurance score in the top tier. Driver B is in the bottom tier. The premium difference, up to $1,500 per year. For the same car, the same roads, the same risk. A Consumer Reports study tested this in 2023 across 700 insurance scenarios. In 88% of cases, a driver with a lower credit-based score paid significantly more, even when their driving history was identical or better. You cannot opt out. In most states, it's legal, but you can fight it. Request your credit-based insurance score from your insurer in writing. You have the right to ask why your premium is what it is. Improving your credit score by even 40 to 50 points can move you into a lower pricing tier. Pay down revolving credit balances first. That's where the fastest score gains come from. Then reshop your insurance. The difference in premium will be immediate. Your zip code can cost you more than 3 speeding tickets. Insurance companies set base rates by zip code. This is legal, widely practiced, and largely invisible to consumers. Here's what that looks like in practice. 2 drivers in the same city. One in a historically lower-income zip code, one in an affluent suburb. Same clean record, same car, same coverage. The driver in the lower-income zip code pays on average 30% more. In some cities, that gap is 60%. ProPublica and Consumer Reports documented this in a landmark 2017 investigation across 4 states. In some zip codes, minority drivers with clean records were paying more than white drivers with accident histories in wealthier areas. You can't change your zip code. But if you're moving, even a few miles, check insurance rates for the new address before you sign a lease. The difference can be $600 to $1,000 per year. That's real money that factors into whether a neighborhood is affordable. And if you're staying put, telematics programs, the apps that track your driving, can override your zip code penalty with actual behavioral data. If you're a safe driver, opting into tracking can reduce your premium by 10 to 25%. Here's the question the insurance industry doesn't want you asking. If telematics can show you're a safe driver and reduce your rate, why wasn't the lower rate your default? Why is safe driving an opt-in discount instead of the baseline? Bundling your home and auto insurance feels like a discount. For many customers, it's a trap that makes switching nearly impossible. The bundle discount is real. It's usually 10 to 15%. Insurance companies promote it heavily because it works, not just as a discount, but as a switching barrier. When you bundle, the friction to leave doubles. Now you have to replace 2 policies simultaneously. Most people don't, so the insurer can apply moderate annual increases to both policies, knowing the combined hassle of switching will prevent most customers from acting. Here's the math. You get a 12% bundle discount up front. Over 4 years, your rates increase 7% per year, roughly the industry average for bundled customers in renewal years 2 through 5. By year 4, you've given back the entire discount and then some, while believing you're still getting a deal. Calculate the actual dollar value of your bundle discount, not the percentage, the dollars. Then get independent quotes for both policies separately. In many cases, 2 separate policies with 2 different companies beats the bundle on price by year 2. The math is the only thing that matters, not the marketing. We started with a simple fact. Your car insurance went up and nothing changed. Now you know why. There's an algorithm running on your account right now. It knows how long you've been a customer. It knows whether you've shopped around. It knows what it thinks it can charge you without losing you. And every year you don't check, it gets a little more confident. The correction takes about 45 minutes. 2 weeks before your renewal, get 3 quotes. Call your insurer with the lowest one. Ask them to match it. If they won't, leave. The average driver who does this once saves $700. The driver who does it every 2 years saves that money indefinitely. The algorithm is not working for you, but now you know it's there. If this saved you money, or if you know someone paying too much for car insurance right now, share this video. That's the only ask.